previously taught academics as an academic at Michigan State and at University of Iowa. So he, like we strive to be, falls in that sweet spot of doing serious empirical work and being policy relevant. And without any further delay, I call Deputy Governor Timothy Ling to the stage.
Thank you very much for the introduction, and thank you for hosting this event. It's a pleasure to be back here and among a number of friends and former colleagues. And so today the topic is foreign exchange reserves, and of course that's a topic that, as Adam indicated, has been a controversial one. It's foreign exchange reserves have played a notable, sometimes controversial role in the global economy and the financial system, and that's partly because of their sheer size, estimated at about $11 trillion recently worldwide. And of course, changes in holdings of foreign exchange reserves and how they're invested can matter not just for exchange rates, but potentially for a whole range of asset prices. Reserves are usually seen as an important element of self-insurance that complements the access to financing that's provided by countries to countries by the IMF and by other multilateral institutions. But in contrast, Canada's foreign exchange reserves stand out for their relatively modest size and for their stability. Our reserves are about $85 billion, which is about 5% of Canada's GDP, and that compares with an average of around 13% for other advanced economies and 20% for emerging market economies. And of course, there are some emerging market economies, notably China, where the numbers are much larger. Now, a key reason, I guess the question that comes to mind then is well, given the modest size, I mean, why do we think that that's an adequate size for Canada? And of course, the key element here is our freely floating exchange rate. And Canada adopted a floating exchange rate back in 1950. And although we had an episode of a fixed rate in through the 1960s, our dollar has floated ever since then, since 1971. And also, we haven't intervened to stabilize the Canadian dollar for over 2 decades now. Now, that's a period that encompasses quite a lot of turbulence in the world economy, in particular, and major changes in our exchange rates. So it includes, in particular, the whole period of the commodities supercycle, when the Canadian dollar went from a low of 62 cents US in 2002 up to $1.08 in 2007. Then during the global financial crisis, there was a precipitous drop in the Canadian dollar, and the Canadian dollar went from that level of well over parity with the US dollar to as low as 76 cents, and then rose up to above parity on the strength of that commodities boom that was still continuing to roll even after the global financial crisis. But then, of course, in 2014, when oil prices collapsed, that also brought a sharp drop in the Canadian dollar by about 25%. And since then, the Canadian dollar has been fluctuating in a pretty wide range, around 75 cents US. Now, these exchange rate movements have actually been helpful for Canada. They've helped the Canadian economy adjust to the shocks that I've been describing. And of course, although the shifts in the exchange rate are always painful for some and beneficial for others, in general, the Canadian economy is diverse and dynamic, and over time has been able to achieve a new balance of growth across regions and sectors. And the exchange rate has been an important factor in bringing about that adjustment. So in my talk today, I'm going to expand on these themes and explain why we stopped intervening in the foreign exchange market. And a central theme is that because we no longer use foreign exchange reserves to intervene in the foreign exchange market, we hold reserves mainly as a precaution against extreme tail events. And in that context, I'm going to talk about what we consider to be an adequate level of reserves and how we manage them. So at the end of the speech, I'm going to also touch on the new U.S., Canada, Mexico, or what's called here USMCA. We call it CUSMA. Put the countries in a different order, but basically that has some that has some language about foreign exchange reserves, which I'll touch on at the end. So most of the time, the experience has been that exchange rate movements driven by the market have contributed to Canada's economic stability, and that's helped Canada to ride out the rising and falling tides of the world economy. Now, in particular, as a commodity exporter, Canada has been subject to swings in world commodity prices, which affect our terms of trade. So I want to, I'm not going to give a whole history, but I'd like to make a few observations that are based on recent experience. And so, you know, to a certain extent, I think the pattern has been that the movements in the Canadian dollar vis-a-vis the US dollar are reflecting the relative strengths of the two economies. And those in turn are linked to expectations about the path of monetary policy. So, in particular, I think over the last year, we've seen an important change in the relative position of the Canadian and US economies, even though the Canadian economy is actually doing pretty well at this point. So we're in a period where the Canadian economy has been growing, has been running close to potential for nearly the past 2 years, and also where growth has been running at a pretty solid pace. And unemployment rates are around historic lows. Employment creation has been strong, and inflation has been hovering pretty close to our 2% inflation target. So in that context, we've also been taking steps to move our policy interest rate upwards by a cumulative 1.25 percentage points. So our policy rate is currently at 1.75%. But there are some factors that, however, have resulted in a temporary slowing of the Canadian economy, and I could enumerate 3 of them in particular. One of them is the uncertainty around trade relations, and for quite a while, this was surrounding the renegotiation of NAFTA and its sequel. And it's really the uncertainty around U.S. trade policies that's been dampening business investment. There's been a sense of a sort of wait-and-see attitude on the part of many Canadian companies, and also to some extent, precautionary decisions to relocate investment in members of a corporate family that are based on this side of the border, and that's resulted in Canadian business investment, which has been not weak by absolute standards, but certainly weaker than we would have expected based on the strong fundamentals, which include very high levels of capacity utilization and generally a climate of business optimism about future sales. Now, another factor is that lower oil prices in recent months have caused a deterioration in Canada's terms of trade, and that, of course, translates into lower incomes and wealth for Canadians, but it also importantly affects business investment in the energy sector. A third element is that housing investment and consumption spending have also softened for a number of reasons over the last several months. So the result then has been, as I mentioned, a temporary slowing of Canada's economic growth. Now, meanwhile, of course, the picture in the U.S. is a bit different, and the U.S. economy has been powering ahead with the effects of the fiscal stimulus. And in response, the Federal Reserve over the last year took several steps to move interest rates towards their neutral level. And that combination of factors has been putting downward pressure on the Canadian dollar. The lower Canadian dollar, in turn, we view as being helpful in supporting the economy through this period of softer growth. Now, it's been almost half a century now, as I mentioned, since we last actually set a target for the exchange rate. And by and large, the movements that we've seen over that whole period have served Canada well. Trying to hold the dollar constant, in our view, would have given us larger fluctuations in employment, output, and inflation. But nevertheless, even though we haven't had an exchange rate target, there was for many years we actually did routinely intervene in the foreign exchange market. And so what we did was to use our foreign exchange reserves to resist in an automatic fashion any significant upward or downward pressure in the dollar. And in particular, between 1995 and 1998, Canada actually intervened in the foreign exchange market 150 times. And of course, that was a period that when Canada was dealing with a high government debt and concerns about that, sort of amplified by political uncertainties around, in particular, Quebec, independence referenda, and so there were big movements in the market. But at that point, the policy of the Bank of Canada was routinely to be in the market and to intervene. But and again, at that period, we weren't targeting a particular level for the exchange rate, but simply smoothing its movements. And at the time, that reflected the belief that the markets were not functioning efficiently and could give rise to volatility that could be destabilizing. But over time, this view gave way to the weight of evidence and experience. And there were a number of research by the Bank of Canada which concluded that the interventions were not particularly effective. And so there was, I think, the conclusion that attempting to moderate these exchange rate movements was more likely to be futile. And I mean, the analogy, which probably doesn't work as well in sunny Washington as it does in Ottawa, is that it was a bit like when you're skidding on ice and you put on the brakes. Then it may slow down something, but actually it doesn't really have the effect that you're looking for a very long time. So where does that leave us? So we do actually have a framework, a policy framework that would allow us to intervene in the event that, in the unlikely event that was needed. And we've actually spelled out two scenarios under which that could happen. One of them is one where there's a market breakdown in the foreign exchange market, and where you've got extreme volatility, basically price gapping in the Canadian dollar, and that would be a context where buyers and sellers in foreign exchange market were increasingly unwilling to transact, and where the level of where there's a severe lack of liquidity in that market. A second scenario would be one where you have sharp and more sustained currency movements, which would threaten the conditions that support sustainable long-term economic growth. Now, in the first of those scenarios, the market breakdown, the idea would be that intervention would likely be quite short-lived. It would be intended to basically restore market functioning, fulfill the side of the market that was lacking, and basically ride out that very short period of market breakdown. But in the second, more sustained extreme currency movements, it's understood that the intervention, if there were intervention, it would have to be part of a much more comprehensive policy package that would be designed to address the underlying causes of the underlying causes of these imbalances. Now, the framework, again, it's transparent. It's posted on our website. And so we are, in fact, ready to intervene if that were needed. But as I've said, we haven't seen the need to do that for at any time through the past 2 decades, which have been certainly, if nothing else, a very turbulent 2 decades. So then that raises the question of, well, how do we think about the current level of foreign exchange reserves, given that we hardly ever use them? And if we look internationally, of course, there are a number of factors that appear to influence reserve holdings, and there's a body of research that explores those factors. And we do have countries like China where movements in the international reserves are largely a byproduct of the exchange rate policy and the trade and capital flows that stem from that. And you also have, particularly in a number of emerging market countries, a conscious decision to hold a large war chest of reserves, which is basically intended to create the capability to offset volatility in capital flows, and to some extent also in a number of emerging market economies, there's a desire to be able to ride out fluctuations in the prices of commodities that can affect their trade revenues. But in contrast, our flexible exchange rate and our policy of intervening only under these defined circumstances, and which has implied never for the last 20 years since we've had that policy, it means that we can actually keep a much smaller level of reserves. So, of course, that begs the question of why, given that we intervene so rarely, why do we hold any reserves, and then how do we gauge whether they're adequate for our needs? And I mean, I guess the first thing is that, of course, even though we haven't intervened for 20 years, there are we have to be prepared to intervene in case of events that are even more severe and therefore probably more improbable than the ones we've experienced, for example, during the global financial crisis. And so we do periodically examine extreme scenarios and estimate the scale of intervention that would be required under those scenarios. A second and also important purpose of our foreign exchange reserves is to ensure that the government of Canada can meet its payments obligations in situations where normal access to funding markets may be disrupted or delayed. And that basically is about insuring against rollover risk for public borrowing. Now, Canada hasn't, in fact, faced any situation where any difficulty in rolling over its debt since the Second World War. So this is, again, it's a hypothetical, but still not insignificant risk. But then in the light of the global financial crisis, Canada did reassess its own potential liquidity needs, and the government at the time made the decision to beef up both its demand deposits, so its deposits at the Bank of Canada, but also its foreign exchange reserves in case of some difficulties in funding its its activities. So that's certainly one of the purposes for which Canada holds reserves. Now, third, Canada's foreign exchange reserves serve to reinforce confidence in the soundness of the Canadian financial system, but have to note that that the reserves are among, and probably last among, a number of factors that do that. Canadian banks manage their risk prudently, and they're well regulated and supervised. Even during the financial crisis, Canadian banks remained in good financial health and didn't have to rely on any direct official support. And 10 years later, Canadian financial institutions have ample buffers of capital and liquidity, and the whole system remains resilient. Financial institutions, with regard to their foreign exposures, are expected to take responsibility for managing their own risks associated with those exposures, and they implement hedging and funding strategies to that end. And in fact, so do other major Canadian foreign currency borrowers, such as provincial governments. In the unlikely event that a Canadian financial institution had exceptional needs for liquidity in US dollars or other foreign currencies, there are swap lines that the Bank of Canada has agreed with other central banks, and those were instituted originally during the crisis. They were kind of revived in a couple of years after the crisis in the light of some of the various stresses around Europe, and then they were later turned into standing facilities among the G7 plus Switzerland. So it's basically so that basically those swap lines are available in case the Bank of Canada had a need to obtain funds in any of the other currencies that are covered by those agreements. Now, the Bank of Canada has never drawn on those swap lines, but it's also never faced a request to provide Canadian dollars under those swap lines. I mean, generally they were more about availability of U.S. dollars in Europe and in Japan at different times. But again, those arrangements are available if needed. So even though it's very unlikely that Canada's foreign exchange reserves would need to be drawn down in any way for financial stability purposes, their existence still provides further reassurance, in addition to the things I've just been talking about, of the safety and soundness of the Canadian financial system, including under very extreme potential scenarios. And that confidence, in turn, helps maintain stability in the event that there is a period of financial stress. So, taking all these potential needs into consideration, Canada sets a level of liquid international reserves. It sets a minimum of 3 percentage points of GDP, and that's a floor that, in general, we exceed. I think I said at the beginning of the speech, the actual level currently is about equivalent to about 5% of our GDP. So that's a floor, but it's one that we typically exceed. And having a floor is simple to communicate to the public, to credit rating agencies, and to investors. And as I noted, that floor level is low relative to a number of countries. It's also in line with some other countries that have more similar policies to ours, including Australia and the United Kingdom. So we periodically review this together with our Department of Finance. And in fact, in Canada, the reserves actually belong to the Government of Canada. They don't belong to the Bank of Canada, but we manage them on behalf of the government. So the policies here are formed jointly with our Department of Finance, and we review them periodically in light of various metrics and international comparisons, and particularly with regard to extreme scenarios that would imply a draw on foreign exchange reserves. The last review that we did was finished in 2016. And it concluded that the 3% minimum was adequate for Canada's needs, even under the kind of extreme conditions that I've been talking about. So then I come to how do we manage our reserves, and again, because the primary purpose of the reserves is precautionary, then the key strategic objective is to maintain a high standard of liquidity under all circumstances. Of course, there's also preservation of capital value and optimization of returns. So obviously, maintaining liquidity means holding reserves and assets that mature or can be sold at very short notice with a minimal market impact. Preserving value means minimizing the risk of loss by holding a diversified portfolio of high-quality assets, managing liquid assets and liabilities on a matched basis, and we also aim to achieve the highest rate of return possible while respecting the first two objectives. So we do diversify our reserves across a few currencies, but we hold a minimum of half in US dollars, and the actual level currently is closer to 2/3. And that's really reflecting the fact that it's really the liquidity of the US dollar financial markets, and the fact that any potential foreign currency need is more likely to accrue in US dollars than in any other currency. So we do hold the remainder of our reserves in euros, pound sterling, and Japanese yen, and that's it. So I want to expand a little bit on a point about asset and liability matching, which is different from any other country that I know of. And there, basically, we hold our liquid foreign exchange reserves in something called the Exchange Fund Account, or the EFA, and the assets are funded by Government of Canada liabilities that are denominated in, or they're swapped into, foreign currencies. And those consist largely of foreign currency securities, which are mostly, the assets consist of foreign currency securities, which are mostly government treasury bills, bonds, fixed income securities, supported by sovereign-supported issuers, sub-sovereign entities, and supranationals. And basically, the assets in the EFA are matched in currency and duration to the government's liabilities that fund the liquid securities, and that's basically to minimize exposure to currency and interest rate risk. So these matching requirements are part of our asset liability matching, or ALM, framework. And to my knowledge, no other central bank exclusively manages reserves in this fashion. I mean, a number of central banks have a portion that they match strictly, but we basically match the whole thing. And it means that we can earn a positive spread on our reserves, and basically have a relatively small level of risk. Now, this approach wouldn't really work if we were intervening with any frequency, because then it would be hard to maintain the matching of the assets and liabilities, because you'd be unwinding the liability position as you're either adding to or subtracting from the assets. But it has been an effective way of minimizing interest rate and foreign exchange risk, which impinge on the government's fiscal position. There is some element of risk that's still remaining, and that's basically the credit spread exposures that are inherent in the assets and liabilities, and the fact that those are not perfectly correlated. The fact that because a lot of the exchange fund account is actually funded with Canadian dollar debt, which is swapped into foreign currency, then it's using cross currency swaps, and of course that implies an element of basis risk, but also an element of counterparty credit risk. But these risks are obviously different in nature from the risks that some other central banks are subject to when they have long positions in foreign currency, which our exchange fund account doesn't actually have. So the other thing here is that we also have our own in-house risk assessments, and this is really in response to the Financial Stability Board's call to reduce mechanical reliance on the credit rating agencies. And so we've actually built our own credit rating structure within the Bank of Canada to do that analysis. So, I mean, I guess that raises, well, why is our approach different from others? And a lot of it is really the relatively small size of our reserves. It's the fact also that we have the asset and liability managing framework and the focus on liquidity. So other countries, of course, are pushed to explore alternative asset classes such as higher yielding bonds and equities because they're focusing on higher returns. And again, because most countries have a net long position in foreign exchange, they in their foreign exchange reserves, they have outright exposure to currency movements, and that's driven a push to diversification into other currencies. So we don't have to worry as much about that because we have this matching between our assets and liabilities. So I want to say a brief word here about gold, which of course is a subject that always comes up in these conversations. And of course, a number of countries continue to hold portions of their reserves in gold. And I mean, I think in some cases, largely for symbolic reasons or historical reasons. But Canada doesn't, in fact, do that. And this is a decision that was taken by the Canadian government in 1980. And over the subsequent period, Canada sold its gold at a gradual and controlled pace and invested the proceeds into U.S. Treasury securities and other interest-earning assets. And the view certainly reflected in that was that gold bullion was not as liquid as those other securities, and also that to the extent that you're dealing with physical delivery, there are costs of secure transport and storage, which could be significant. And so gold doesn't really fit within the sort of asset liability framework I was talking about. It's really something that implies a very different view of what reserves are for. Now, I want to touch on another of the recent developments which we've been monitoring closely, and that's the use of the Canadian dollar as foreign exchange reserve for other countries. Now, particularly in the wake of the global financial crisis, a number of central banks and monetary authorities started adding Canadian dollar assets to their reserve portfolios, and reserves in Canadian dollars are now around $200 billion, and that's about 2% of aggregate international reserves. It's also getting on for 3 times our foreign exchange reserves. So a lot more other countries are holding reserves in Canadian dollars than Canada is holding foreign exchange reserves. So that's, in general, that's reflecting a broader strategy of reserve diversification. And to some extent, it's also, I think we would say, a vote of confidence in Canada. It's really the soundness of Canada's financial system and fiscal position that makes the Canadian dollar seem like an attractive currency for reserves. But even though the Canadian dollar reserves are only a small share of global reserves, the total allocations to Canadian dollars may be large relative to the size of our financial markets. And combined with the fact that some reserve portfolios are really a buy and hold kind of portfolio, that can actually, these inflows from reserve managers can actually have a pretty material impact on Canadian financial markets, and particularly that in government bond markets where those reserves are concentrated. And even though the flows are often comparatively stable, it's more of a longer-term strategy of reserve diversification, and so there aren't really sudden changes in those flows. At the same time, they may put sort of gradual downward pressure on yields, and that, of course, on the whole, can be good for the government in terms of lowering its funding costs. But at the same time, the increasing presence of these large buy and hold investors could negatively affect the market's liquidity because of the effects on secondary market trading and the availability of collateral. So it's something that's not all, potentially may not be all beneficial. So this is something we continue to assess, and particularly the potential implications on our bond markets and and for financial stability. And that's particularly relevant because those are what we'd call core funding markets. So in concluding, I'd like to touch on the new Canada-US-Mexico agreement, or CUSMA as we call it, but it's called USMCA. And that's, of course, been signed but not yet ratified. And in one chapter, the parties are enjoined from manipulating their exchange rates to gain an unfair trade advantage. So, as it should be clear from my remarks, this is not a controversial issue for us. We've long been relying on our market-determined flexible exchange rate to absorb external shocks and to cushion the economy from their impact. This policy has served Canada well, and without a freely floating currency, prices, wages, and unemployment would fluctuate much more markedly, and that would have adverse effects on people and on businesses. And so the flexible exchange rate is also essential for us to be able to pursue an independent monetary policy. The other element of this which is also part of the terms of the trade agreement, is that we already maintain a high standard of transparency, both with regard to our framework for managing foreign exchange reserves and the publication of the relevant data. And this speech is really another step in trying to make sure that everybody fully understands this framework. So, thank you. Okay.
This is exciting. We brought out the brand new good microphones for you. Joking aside, Tim, that was fantastic. It not only contributes to the happy image of Canadians as frank speakers, pragmatic, calm, forthright, it contributes and is consistent with what we know about the Bank of Canada inflation targeting regime, that you all are very self-scrutinizing, very open, and very focused. And I had the privilege a few months ago to be at the Bank of Canada conference when you were discussing rethinking the inflation target.
Yeah.
And obviously very high quality work there that you and your colleagues are doing. I guess, though, even though it's going to put you in an awkward spot, I have to ask the question. It's not the one you think. Since you make it so clear.
Somebody said there are no bad questions, there are just imprudent answers. Yeah. But okay, go ahead.
I have no doubt about your prudence. You make it so clear and so sensible that Canada is pursuing this strategy with respect to exchange rate management as part of its overall monetary framework. So why do all these other countries get it wrong? What's special about Canada, or what are they missing? I know you don't want to talk about specific other central banks, but seriously, your logic would seem to apply maybe not to everybody, but to a large range of countries, and very few countries are pursuing your policy. What do you think is going on?
Well, I think there are probably a number of factors that makes Canada better able to live with a fully market-determined exchange rate than some other countries. I think the fact that we have we do have a widely diversified economy, even though we have we are a commodity exporter. We're subject to fluctuations in commodity prices. At the same time, raw materials are somewhere in the neighborhood of 10 to 15% of our economy. Mm-hmm. Oil and gas production is 3.5% at this point. It's lower than it was, 6 or 7 years ago. But basically, that we have a diversified economy, so there is actually scope for us to let the exchange rate move in response to economic forces, and that gives a boost to the rest of the economy and helps the structural adjustment. Now, obviously, for countries that are more heavily dependent on raw materials, there's less of a rest of the economy for for those effects to work on. But for Canada, I think the structural adjustment that has to take place when there are sustained movements in commodity prices is something that's facilitated by the exchange rate movement. So that's one thing. I mean, a second thing is that a financial system is able to cope with these things, and it does go to some of the things I mentioned in the speech. The fact that our banks are pretty conservatively run, they're conservatively supervised and regulated, and generally they're well placed to deal with variations in. I mean, they do a lot of hedging, even though they have large scale activities on both sides of the dollar of the border and in different currencies. They have learned to cope with the kind of variability in the exchange rate, and they aren't exposed to these movements. So, I mean, it is. I can see that there are more issues for countries that are more reliant on foreign currency borrowing, whose financial institutions are less well able to cope, or that have less diversified economies. But for us, it works.
Mm-hmm. So, thinking about, rather than getting into listing who those economies are, let's turn to another piece of what you discussed, which obviously is the currency part of NAFTA 0.8.
Yeah.
So you're also, not you personally, not the bank, the sovereign nation of Canada is also a signatory to CPTPP. There's word that the Trump administration is trying to put all kinds of constraints on members of CPTPP, including Canada and Japan and Mexico, in terms of their interactions with other economies like China and in terms of their exchange rates. Just speaking generically as a central banker and as someone who worries about these things, how much do you think these kinds of things should be subject to international agreement rather than sort of, I don't want to say gentleman's agreement, that's not correct, gentle person's agreement? And how much do you think requirements from politicians to try to put exchange rates into trade deals is a good thing versus keeping them separate?
Yes. Well, it's. I mean, certainly to some extent. I mean, I did mention in the case of the the case of USMCA, and the same would apply to the same would apply to TPP. That the language is, I mean, in our view, is not. I mean, it's only actually validating things that we already do and things that are already part of our agreements as members of the IMF, and in fact, so that whatever the merits or the optics of putting it in a trade agreement, it's something that doesn't actually put additional constraints on Canada's ability to, or any of the members, at least it certainly doesn't put constraints on Canada's ability to choose its own exchange rate policy, its own intervention policy, and its own to run an independent monetary policy. So from that point of view, this is really not a factor. I mean, of course, in general, we see around the world that a number of countries have different. Legitimately choose different monetary policy and different regimes for all of those things, and in general, there's some benefit to them to be able to adapt those things to the conditions that they face.
Right, very measured. Let me open it up to the audience. Please go to the standing mic and identify yourself.
Fred Bergson from the Institute. Tim, thank you for the very comprehensive presentation of your policies in this area. Early in your remarks, you noted there had been at least a couple of periods of substantial appreciation of the Canadian dollar.
Yeah.
My question is whether that led to any concerns in Canada about adverse effects on your trade competitiveness. When Joe and I did our book recently on currency conflict here, we discovered, and much involved in that several years ago, that there was a lot of backlash in the U.S. against currency manipulation because it was perceived to lead to dollar overvaluation, therefore adverse effects on U.S. competitiveness, which contributed to the backlash against globalization. So my question is whether you saw any of that in Canada. Did you get any concern from your business community, your exporters, and did your colleagues in the Ministry of Finance, with whom you share policymaking in this area, lean a little more in a mercantilist direction versus your more monetary policy-oriented direction when it came to determining how to maintain your exchange rate policy during those periods?
And let me, before you respond, let me just add a codicil to Fred's very apt question. And if you can figure out how to do that and we can apply that to Congress, please tell us how.
Yeah, I mean, short answer is yes. There were concerns in Canada, and particularly because it is a big structural issue, and there was a period through the commodity super cycle where the Canadian dollar was pushed to a pretty high level, and combine that with the fact that productivity growth in Canada was not that strong, and wage growth was still running at a reasonable level, and we did have a situation where the competitiveness of Canadian exports was suffering, and of Canada's non-commodity exports, and that, of course. It was a significant part of the economic backdrop in Canada. Now, obviously, from the point of view of monetary policy, we still have to respond to the whole economy. We can't run a policy that's targeted to one sector. But we were certainly aware of the fact that Canadian exports were weaker than we would have expected. And this is particularly the case. We're particularly aware of this in the period after the global financial crisis, where, for Canada, we didn't really have a financial crash, but we did have an export collapse. Basically, our exports to the U.S. Dropped disproportionately to the slowdown in the U.S. in 2008-9. And we were expecting them to bounce back, but I think one of the reasons they didn't bounce back was the fact that, as you alluded to, the Canadian dollar was making Canadian exports less competitive, and that was making it harder for that for even as the U.S. market recovered in the years after the crisis. It meant that Canadian non-commodity exports didn't pick up as much as we had been expecting, but. Again, I mean, in terms of the implications for policy, I think there was a view that this is something that would go into the macroeconomic outlook. It's something that would affect our projections for exports, and we had to revise those in light of that loss of competitiveness. But at the same time, we still have a target for inflation. We have we had an economy that required monetary policy stimulus for several years, as it turned out, to bring the economy back to potential. But it was something that that had to be still the guiding principle, and not looking at any particular sector.
Thank you.
Was there any pressure to limit the appreciation?
Well, there was talk out there in public about that, but it wasn't the case where there was strong pressure on the Bank of Canada to do something different. I think we've had an inflation targeting framework for 25 years, and I think there's generally an acceptance that that's the best framework for Canada, and so there wasn't really sort of a questioning of that on a large scale.
Can I ask those who are interested to queue up at the mic, please?
Thank you. Shakil from the IMF. How do you think about the thresholds for extreme volatility and market dysfunction that will get you to intervene?
Sorry, could you repeat that a bit more slowly? It was hard to hear.
How do you think about the thresholds for extreme volatility and market dysfunction that would get the Bank of Canada to intervene?
Thank you.
Well, I think it's more it's one of those we'll know it when we see it kind of things, and it's basically. But the sort of thing we'd be looking for is a sense that the market is gapping, that that you've got discontinuous movements in the exchange rate because there's nobody on one side of the market. And of course, we have people in our trading room who are keeping keeping an eye on conditions. And I think in a context where something like that is brewing, then we'd have probably a lot of made to understand what was happening. So it's a price action, but also market intelligence, but very short-term market intelligence. I mean, just trying to understand who's in the market and what's going on. But that's the kind of flavor to this. And again, it's something we never saw, even through the global financial crisis and through all the concern about Europe in the early teens and so on. But it is something that of course we would be alert to in conditions where market stresses were building up.
Thank you. Please.
Hi, Jim Boughton with CG. Tim, I have two quick questions. The first one, when we were at the IMF, the big picture that came out of our research was that the problem with floating exchange rates is that they get determined much more by developments in financial markets than by developments in real trade. And you're painting a much more benign picture for Canada, where exchange rate gets primarily affected by what's happening in world commodity markets relative to your export production. And so I wonder, is it just that the Canadians are really good at managing all these things, or is Canada more insulated from the kinds of speculative pressures in financial markets that seem to affect everybody else? I mean, it seems odd. And quickly, my second question has to do with China. I mean, 3 years ago, the IMF added the renminbi to the SDR basket and made it an operational currency, and you've not added it to your own portfolio. So I wonder if you would say a little bit about what it might take to get the renminbi in there along with the other currencies.
Okay, sure. Both good questions. I mean, on the first one, I mean, why aren't we subject to as much volatility and these flows driven by markets? I mean, there was actually a period in the 90s, and the period I referred to earlier, where the exchange rate was being driven around partly by concerns about Canada's fiscal position, because we had a large public debt at that time, and that was sort of playing off of the political uncertainty. And so in that context, we had a lot of volatility in our markets and in our exchange rate, and so that was an episode. But I mean, that was really there was really a serious wake-up call for the Canadian government, and it led to a push to bring our fiscal position into balance, so we'd have room for maneuver on the fiscal side, and so that our debt dynamics would not be as subject to market-driven changes in funding costs. And so that was that whole move, I think, has been very helpful in making us less subject to those forces. On the renminbi, I mean, it's really about liquidity. The fact that and as I mentioned, that's really paramount as an objective for our foreign exchange reserves. And at this point, I mean, the liquidity in renminbi just isn't similar to the other currencies that we're holding. I mean, if there were a further opening up of capital markets in China, more sort of seamless ability to transact onshore and offshore, and similar sort of evolution of money markets and hedging products and that sort of thing in renminbi, then of course that would be the sort of thing that would move the advice in a different direction. But at this point, we do reassess these things and decided that this limited basket of currencies is actually quite suited to the purposes for which we hold the reserves.
Thank you very much. Just have a drink.
Sherman Robinson and Peterson, it's actually a follow-up on that. In your list of currencies you hold, you did not mention the euro. Do you not actually...
Oh, did I not mention the euro? That must have been a slip of the tongue. We do hold euros.
Very good.
Yeah, you said sterling and yen. Okay. Also euro for all our European friends watching live.
Okay.
I think I heard euro. So Ted Truman.
Oh, okay.
Ted Truman, Peterson.
Certainly in the written text, so it's
yeah. Very interesting talk. I'm old enough to know when although you had a floating exchange rate for a long time, as you said, you were heavily engaged in the exchange market for much of that period. And I also remember, Fred, that when the United States suddenly, in the case of the U.S.-Canada Free Trade Agreement, decided they wanted to have a currency chapter in that agreement, it almost derailed the agreement before the Treasury backed down. So times have moved on. So my question, I could have lots, but I got to leave myself to one.
If you're concise, you can have two, but to the point.
So you mentioned the problem of the potential problem of the fact that there are $200 billion of Canadian dollars worth of foreign exchange holdings, which potentially might have an impact on conditions in the foreign exchange in the Canadian dollar financial markets. So what would you do about it? What would be, so if you found that it was not $200 billion today, but $500 billion today, I mean, there are two sides to this. One is the Bergston side, if I may put it that way, driving up the Canadian dollar, but the other side is just the financial market aspect. Have you thought at all about what you might do to discourage, if I might put it that way, holdings of Canadian dollars by foreign central banks?
Sorry.
We're not really into discouraging it. I think it's more a matter of, understanding it to the extent that it's an influence in the market. And then there's some technical stuff we can do, and particularly, I mean, an example would be securities lending, because we're actually foreign reserve holdings. And so to the extent you've got sort of buy and hold, it's kind of taking those bonds out of circulation. But if we offer the facility to do securities lending, then that could be something that would then make them available as collateral and help to provide more liquidity in the market. So there is that kind of technical stuff we can do to the extent that we think that it's an issue.
Can I just follow up briefly on Ted's questions and the general discussion? This has been great, Tim. The first one is, Ted sort of touches on something that's a general policy issue now, which is macroprudential aspects of capital inflows.
Yeah.
There are a lot of countries for whom it's not just the already big issues of what does it do to the trade economy, what does it do to the exchange rate. It's imbalances in domestic assets. And again, it's probably vastly exaggerated, but anecdotally, people cite Vancouver, for example, a lot, that there's a lot of Chinese money, private sector Chinese money moving into the Vancouver real estate market. So you've been relatively calm about saying no intervention, but I know, as all central banks are, the Bank of Canada is thinking about macroprudential issues. How do you view that, and what measures do you need on that side, if any?
Yeah, well, of course, that's been an issue that there's been a lot of public attention to, but it's not something that we think foreign exchange market policy really is very well adapted to. And so, I mean, in terms of the broader housing market, I mean, there are a number of things that are currently in place. There's kind of a cocktail of measures that include what we've done. We've raised our policy rate, which we've done for the right macroeconomic reasons, but it also is helpful in terms of reining in some of that excess borrowing that's been going on. I mean, a second thing is the fact that there's been tightening of a whole series of measures the federal government has taken to tighten up the rules around mortgage lending, and including the sort of initially several steps of increasing the requirement for down payment for mortgages, but then on top of that, there's more recently this stress test so that households can't take out a mortgage unless they can afford the payments at an interest rate that's 2 percentage points higher than the prevailing one. So that's all serving to dampen the market. But then there's also been some provincial government and municipal government stuff aimed at Toronto and Vancouver,
right. And
that includes measures to tax non-resident or non-Canadian purchasers of property, and so those measures then address some of those flows which are really not related to the Canadian financial system.
Thank you. Yeah, please.
Morning, Tim. Hyun Lim from the IMF. Just to pick up a little bit on the housing issue, you mentioned earlier that reserves are about 5% of GDP. And in 2016, you did a review and you felt that the 3% minimum is still valid. But looking at the housing market, the Canadian government is also in a business that many other governments are not, which is to provide mortgage insurance in place of private insurance. And that amount is about, 30-something to 40% of GDP. So that's about 6-7 times more than what you're holding in reserves. And part of that, and not part of that, but in addition to that, we see external debt is also about that external debt of banks, particularly on the short-term side, is also around sort of 6 to 7, well, maybe 5 to 6% more than the 5% of GDP. Taking all of this into context, and one more factor is household debt in the meantime has also increased to very high levels because of the housing sector. So taking all of this, the fact that household debt is so much higher, the fact that banks hold quite a substantial amount of short-term external debt, and thirdly, that the governments insure a substantial part of the housing market. What was the criteria in 2016 when you did the review that led you to not adjust the 3% minimum? I would have thought that given these three reasons, the minimum may have been increased. Thank you.
Well, I wouldn't put those numbers on the same ledger in the sense that that none of those things that you mentioned are really a claim on foreign exchange reserves. I mean, they are things that certainly the household indebtedness is something that is it is a financial stability issue, and it's something that we've been talking about for a number of years in that regard. But and as you said, I mean, there is a government backstop for mortgage insurance, which of course is a two-edged sword. It on the one hand, it can be a stabilizing force in the sense that if you did have a downturn, it makes it less likely that sort of cascades into an episode of financial system stress. On the other hand, it is obviously something that would go on the government. Ultimately, if once the reserves of the mortgage insurance funds had been used, then there would be ultimately the government standing behind that. But again, that it's not clear that any of these why any of these would actually imply a requirement for holding more foreign exchange reserves. I mean, these are all domestic liabilities, and even the foreign liabilities of the Canadian banks are generally hedged. I mean, they have assets as well as liabilities outside of Canada, and so that means that they're not really exposed to in a material way to exchange rate risk. So anyway, in general, that's something that was, it of course the whole picture was considered in the assessment of reserve adequacy, but these numbers are really not ones we'd put side by side.
Tim, given your long career, not just as deputy governor at the bank, but the IMF, I'm going to ask you, as you put it, an imprudent question as opposed to an imprudent answer, by essentially flipping the previous question on its head. Mm-hmm. Why bother to have any minimum level of reserves at all? I mean, if you're going to have 3 or 4% of Canadian GDP compared to the capital flows that can come in and out, that's trivially small. So what ultimately matters is the willingness of the Bank of Canada and the government of the Bank of Canada to intervene in some fashion. I mean, we saw China sitting there, our colleagues, you and our colleagues at SAFE, spent $1.5 trillion defending the renminbi in 2015, 2016, and that wasn't going to be enough. So they had to use other measures. So, I mean, I'm not saying you should get rid of your reserves, but it's like, why is there a minimum at all? Because you're not holding enough that's going to matter.
Well, I mean, it's really a protection, as I sort of indicated in the speech. You're protecting against the tail of the tail. I mean, it's an extreme event. It's events that are so extreme that we haven't even seen them through the global financial crisis and the other thing. And in that setting, of course, level of reserves. Take the main scenario we think about, which is breakdown in foreign exchange markets. We didn't see that, but certainly it is the kind of thing that can happen if there were some major credit event or something like that you have. We did see that in a lot of markets, but just not in ours in 2008, 7, 8, and in that kind of context, where markets are actually breaking down, you don't necessarily have to intervene on a huge scale, but you need to intervene in a decisive and convincing way, and you need obviously enough reserves to be able to show that you can do that and not use all the reserves you've got. So it's kind of it's a matter of not just being prepared for those events, but being visibly more than prepared, I think is part of it.
I think we have to call it here. This is the Deputy Governor Lane has been incredibly open and most importantly substantive, which is again a wonderful contrast to what we've had in Washington of late. And we're very proud to continue to have intellectual and policy exchange with the Bank of Canada. Thank you all for listening. Thank you for coming today.
Thank you.